Welcome, executives. If you look at the news right now, every single headline is screaming about chaos in the Middle East and the surging price of oil. But as leaders and investors, we really have to look past those loud distractions. We need to examine the creeping, silent financial decay happening right now on the balance sheets in Tokyo. So, in this explainer, we're going to unpack a quiet crisis that is seriously threatening global debt markets.
So, I've got a direct question for you. Is your portfolio exposed to Tokyo's debt? It's something we absolutely all need to be asking ourselves when looking at the macro environment. Because in 2024, after 17 long years, the planet's biggest creditor officially ended its era of free money. And what does that mean for us? It means every mortgage, savings account, and 401k is potentially right in the crosshairs. To protect our assets, we really have to understand the exact mechanics of how this is unwinding.
We'll be tracing this economic tragedy through 5 distinct acts today. First, the demographic death spiral, then the infinite money glitch. Act 3 is the widowmaker. Act 4 is the great repatriation. And finally, the sovereign debt trap. Basically, we're following this chronological unraveling from zero-interest hubris straight to systemic global collapse. Let's dive in.
Act 1, Demographic Death Spiral, the cracking foundations. To really grasp the debt situation, we have to look at the underlying population decay that first backs Japan into a corner of economic desperation.
Back in 2010, Japan's population sat at about 128 million. Fast forward to 2026, and we're looking at roughly 122.6 million. To put that into perspective, they are essentially losing an entire city the size of Atlanta, 500,000 people, every single year. And as this aging workforce exits the economy, Japan's tax base is just mathematically collapsing, which completely accelerates their sovereign debt crisis. And here's where the reality gets brutally simple. 2 to 1. Right now, there are 2 deaths in Japan for every single birth. With more and more retirees draining resources and way fewer workers paying taxes, the financial foundation of the country has fundamentally cracked. And the mathematical consequence of that shrinking tax base? Public debt absolutely spiraled to a staggering 260% of their GDP by 2022. Now, historically, Japan kicked this can down the road by pioneering quantitative easing decades ago. But to survive this modern tax shortfall, the Bank of Japan had to act out of pure desperation. They kept interest rates at zero and literally socialized their stock market just to keep the lights on. Which brings us to Act 2, Infinite Money Glitch. The illusion of free money. Let's look at how this setup turned into an unprecedented, ultra-high-risk central banking gamble that Wall Street was very quick to exploit. Okay, this is absolutely crucial. It's called the yen carry trade. Wall Street hedge funds basically realized they had a real-life video game infinite money glitch on their hands. It was 3 simple steps. Step 1, borrow huge amounts of Japanese yen at literally 0% interest. Step 2, convert that cash straight into US dollars. And step 3, use those dollars to buy US tech stocks and treasury bonds. It was a seemingly foolproof way for hedge funds to guarantee massive returns. But, as any gamer out there knows, glitches eventually get patched. This whole system was just a band-aid over a broken economy. And as this patch finally goes live, global companies that built their entire balance sheets relying on that cheap yen debt are now facing immediate insolvency risks. Their borrowing costs are threatening to multiply literally overnight.
Act 3, the widowmaker. The math flips. This is where external global pressures finally detonate the long-feared financial bomb known to short sellers as the widowmaker. Think back to when a 50% surge in crude oil sparked massive global inflation. Central banks worldwide aggressively hiked rates. The US went up to 3.75%, Australia to 4%, Mexico hit near 7%. But Japan, they were trapped. Raising rates would instantly bankrupt a government carrying the highest debt-to-GDP ratio in the developed world. But if they kept rates at zero, they'd sacrifice the value of their own currency. Ultimately, they chose to persist with zero. The result was catastrophic. The Japanese currency went into a complete freefall, shedding 30% of its value in just a few short years. By 2026, it was hovering near its weakest point in decades. And this doesn't just crush domestic salaries in Tokyo. Currency instability of this magnitude, coming from a major G7 nation, sends violent shock waves outward. It severely destabilizes emerging markets all over the globe that heavily rely on predictable exchange rates.
So, panicking to stop their currency from becoming completely worthless, policymakers finally caved. They raised rates to 0.75%, with plans to hit 1% by 2027. Now, 1% might sound tiny to us, but for Japan, that is a seismic shift. It officially detonates 17 years of free global borrowing. That famous widowmaker bet, shorting Japanese bonds against decades of history, it finally paid off.
Act 4, the Great Repatriation, the invisible crash begins. This is the catastrophic, almost invisible shockwave that the mainstream media really isn't explaining to you right now. The rapid repatriation of Japanese capital away from the United States.
I want you to really consider this astronomical figure, $1.2 trillion. That is the amount of U.S. treasuries owned by Japan. That's enough to fund the entire American military for roughly 18 months. It is a massive, massive amount of American debt held in the hands of a single nation across the Pacific.
Let's break down the incentives here. In the past, Japanese megabanks and the GPIF pension fund gladly held U.S. debt because America paid interest, while Japan paid nothing. But as Japanese 10-year bond yields surge past 2%, that math entirely flips. Suddenly, they're highly incentivized to sell their U.S. treasuries and bring that money home. And when the largest foreign holder dumps U.S. bonds, that sudden oversupply forces the United States to raise its own interest rates just to attract new buyers. So when Japan bows out, you get this terrifying chain reaction. The Federal Reserve hikes rates, which causes domestic mortgage and credit card rates to absolutely soar. Highly leveraged sectors like commercial real estate and tech become incredibly vulnerable. Because as borrowing costs explode, hedge funds are forced into a cascading sell-off. They have to liquidate and dump major equities like Apple, Nvidia, and Microsoft just to cover their spiraling yen debts. It's the death of the yen carry trade happening in real time.
We call this the invisible crash. Unlike a loud panic on the trading floor with bells ringing and people shouting, this crisis just quietly bleeds out in the background. As an investor, you need a warning signs checklist right now. You should be actively monitoring the yen to dollar exchange rate, watching for sudden spikes in the U.S. 10-year Treasury yield, and tracking liquidity in corporate credit markets. Because that cheap yen grease keeping the wheels turning, it's drying up.
And that brings us to Act 5, Sovereign Debt Trap, the final countdown. This is the climax of our tragedy, highlighting systemic risks that are poised to destabilize international stock markets for a generation.
After 20 years of kicking the can down the road, Japan is pinned in this ultimate, inescapable trap. Option A, they keep rates low, their currency collapses, and the country starves. Or option B, they raise rates, their national debt burns, and the global bond market detonates. There's no magical fix left. If this sovereign debt system fails entirely, we're likely going to see aggressive global economic reforms, things like digitized central bank currencies and strict capital controls. So to protect personal portfolios and retirement accounts right now, executives must look toward defensive asset allocations. We're talking prioritizing hard assets, commodities, and short-duration, high-quality bonds over heavily leveraged equities.
Because listen, the yen is just the first domino. The U.S. dollar is next in the crosshairs. If the U.S. is eventually forced to monetize its own massive debt, we risk a long-term shift where the dollar loses its absolute global dominance, fracturing international trade into regional, gold-backed, or multi-currency blocks. So I'll leave you with this chilling final thought as you review the health of your own bond markets and portfolios. What happens to your wealth if the U.S. economy crashes next? The era of free money is officially over. Thank you for joining me for this explainer. Stay focused and adjust your strategies accordingly.